Station.
Welcome back. I'm Vincent Perryman and you're watching Legalese. Joining us on our show is Gus Wilson. We're discussing the Emergency Economic Stabilization Act of 2008, specifically the tax provisions in that. Gus, before the break we were talking about the AMT patch. How long does that patch work on that alternative minimum tax fix?
Right, Vince. Well, unfortunately, the patch is only set for 12/31/08, so only for this year. Then it reverts back to its original thresholds, which were $45,000 for married filing jointly, so on and so forth for the individual married filing separately. So the patch is indeed just that, a patch. Going forward, I guess it would be incumbent upon the new president and then the new Congress to promulgate the laws necessary to fix the AMT permanently or to not fix it as they need the tax revenue or not.
All right. With there were some other individual tax issues in there. I think there was several tax deductions that were new and some that were extended. If you could tell us about those.
All right, well, we'll go into it. This is probably the meat of the individual changes for 1040 purposes. And it's a really good idea to know what these are, to consult your tax advisor and really start planning ahead. The biggest one is an extension, the sales tax deduction extension. Essentially what that means is that you have the option to deduct sales tax paid in your state or income tax. And obviously you'd pick the greater of either or. Tennessee residents in essence benefit the most from this, as there is no income tax in this state. We do have a Hall tax, which is tax paid on dividends and investments. But the thresholds for the investment income are quite high. I think it's $2,500 for married individuals. So most people in Tennessee are able to deduct sales tax as an additional deduction on top of anything else they might be deducting for Schedule A. Sales tax, essentially if you think about it, there's two ways to do it. One is using government-provided tables, which is a conservative estimate of how much you spent on taxes during the year, based on AGI, adjusted gross income, and multiplied through by dependents, or how many people are in your household and how many people you're claiming on your tax return. The other alternative to save your receipts, which obviously I'm giggling because it doesn't sound too worthwhile to save all your tax receipts for the year, but the tables are very conservative and they probably don't take into account all the tax that you spent during the year on those receipts. So if you did save your receipts and you did kind of a batch total, you'd probably come out ahead in the long run. One other thing to talk about for sales tax deduction is that if you had big ticket items, cars, vehicles, things like that, you're allowed to take that sales tax over and above what's calculated on the tables. Okay. Any questions?
Well, that sounds pretty good there. I think we probably need to clear up one comment about the Hall income tax, that the $2,500 there, when we refer to that being high, that's in dividend and interest income.
That's correct. And it also, it's only dividend and interest income for banks outside of the state of Tennessee, too. So if you have interest income from First Tennessee, it's tax exempt in Tennessee for the Hall income tax.
All right. And as far as, I think the tuition deduction was extended to 2009. You want to run through that for us?
Yeah, just briefly. The tuition deduction, what it does is allow people to take an above-the-line deduction. And what I mean by above the line is that when calculating your AGI, you're allowed to deduct this in that calculation, which affects some of your thresholds for tax and for tax credits, essentially. So the above-the-line deduction is $4,000 max. But there are certain limits. Essentially, if you're an individual and you earn more than $65,000, you're not allowed to deduct this as an above-the-line tax deduction. And if you're married filing jointly, the threshold is raised to $160,000. Okay. This also, real fast, might interfere with the tax credits that you're hoping to receive. You have the choice of doing a straight deduction or a tax credit, and the tax credits would be the HOPE and the Lifetime Learning Credit. HOPE allowed in your first year of education, Lifetime Learning Credit allowed throughout the rest of your term of education. And we're talking about post-secondary education, higher education, college, so on and so forth.
And then I believe there was an interesting real estate tax deduction that was extended through 2009. If you describe that for us.
Right. The real estate tax deduction, it was in place and it has been extended. Essentially, if you're a non-itemizer and you're using the standard deductions, what this allows you to do is actually deduct some of the real estate tax you pay on your residence on top of your standard deduction. So in effect, what it's done is moved the threshold. I have the numbers here. Essentially, if you're a single taxpayer, you get an additional $500 on your standard deduction, which raises your deduction to $5,950 from $5,450. And if you're married filing jointly, you get $1,000. And so it raises your standard deduction from $10,900 to $11,900. This only affects people who do not itemize, once again. So if you're itemizing, really doesn't affect you that much, but if you don't itemize and own a residence, this is a huge pickup for you.
And then I believe they also extended the teacher's classroom expense deduction for 2008 and 2009.
That's right, and this thing is good. Everyone knows a teacher, and everyone knows a teacher who can benefit from this. I mentioned AGI earlier. This is another above-the-line deduction. It's $250 of out-of-pocket classroom expenditures. And out-of-pocket means essentially school books, teaching aids, chalk, pens, pencils, paper, etc. Just pretty much everything. This doesn't preclude them from deducting their additional classroom expenses on their Schedule A, but remember that it's subject to certain minimums that you have to meet, namely the 2% floor on miscellaneous business deductions.
Okay. And then I believe also the tax-free IRA distributions were extended through 2009. If you can give us sort of a brief overview of that.
Right. The tax-free IRA distributions is kind of a special animal, and it has been extended. It's been very popular with people who have large IRAs who don't want to take the distributions, and it's good for both traditional IRAs and Roth IRAs. But essentially what it does is it essentially allows the individual to make a contribution to a bona fide 501c3 charity of up to $100,000 from their IRA. But the only thing to remember that there is no charitable deduction allowed for the amount that you have had to pay tax on normally. So therefore, it's just, I think it really is in effect reducing your estate and also allowing you to distribute out some of your IRA earnings to a charity of your selection.
All right. When we return from our break, we'll talk more with Gus Wilson about the tax changes that the bailout plan put into place. Please stay with us.